Hey, Tooth and Corners, this episode is going to be a fun one, and one that I hope to make a recurring segment in the Tooth and Coin library in terms of podcast and everything like that. One of the biggest questions, one of the biggest mysteries to a lot of dental practice owners is, how do I even look at my financial performance? How do I measure my business performance? How do I correlate and combine my financial outcomes compared to my practice results? And so in this episode, I'm going to walk you through how to analyze your financial statements, how I look at financial statements. This is from experience of doing this thousands, if not tens of thousands of times at this point in my career, working exclusively with dental practice owners over the course of the last dozen years or so. It's going to be going through a demo of how a team member randomly select a client's financials and situations that we use. We obviously removed all important information from there so that it's confidential, but it's a live case study of how to analyze a set of financials, and we'll go over everything like I was going over this with a client, so you can understand like how I analyze things and how you should too. So buckle up, and here we go. Okay, so the first thing we're going to do is we're going to look at the balance sheet. The balance sheet is a fantastic report to look at. However, it's super limited in what it can actually even tell you about in terms of a dental practices situation and things like that. I'm going to make this pretty quick in how you analyze a balance sheet. The way you analyze a balance sheet, there's three things that are out there. One is, how much do you own? So your total assets. How much do you actually own as a business entity? The balance sheet is a snapshot in time of the balances that are in your business. So it's a snapshot as of the date of every column here. So this is a monthly report over a 4-month period, and it shows how much this person owns. So it's the total assets. That's a combination typically of cash and cash equivalent accounts. It includes fixed assets, net of depreciation, as well as any goodwill, net of amortization included on there as well. So for this business, this person owns assets worth around $270,000. Now, this is not the actual market value of these things. It's not what this person would likely sell this business for, but it's the tax value that would be reported on a tax return on the balance sheet on Schedule L of that person's 1120S, or not reported at all if it was a Schedule C on a 1040. And so this is what you own. The other thing that's on the balance sheet is what you owe, which is your total liabilities. And the net of those two, so how much you own minus how much you owe, is your equity. So if you look here at $272,000 minus $168,000 is $104,000. This is a really confusing component of the balance sheet for a lot of people, because if you say, this is my equity in my practice, a very simplistic way of viewing that is that this is how much your investment is in this company. Because as of right now, if you have $104,000 in basis, that means that this doctor could likely pull out all of this cash if they wanted to and have still positive equity in their business. Not really a huge deal, not something that is very commonly looked at for most people, and is really not that great of a thing to look at from an analysis perspective in determining the financial health of the business. I will say that whenever I am looking at practices and analyzing things, I do sometimes look at the balance sheet just to give me kind of an idea of what's happening with this business. And generally what I'm looking at is I'm usually looking at cash. I'm usually looking at liquidity of like, how much in capital are we having in a monthly basis? Is it going up by a whole lot? Is it a whole lot of volatility? Is it going down by a lot? And how much in assets do we actually have in that business account? That's only one side of the equation. I'll get to the other side of that equation when I talk about combining financial analysis into performance analysis. But in terms of how much you have, it's all relative, right? One person's 80,000 is another company's 800,000, which is another company's 8 billion, right? Tesla couldn't exist with $80,000 in capital. It just depends on what your needs are as a business owner. But I do look at it in terms of trends just so I can get kind of understanding of like, hey, how are things going from a liquidity standpoint? I don't really look at asset value a whole lot. Maybe if I'm looking at a very brand new practice, I'll look at it a little bit to see how much we're investing in new items. Same thing on liabilities. Generally, if liability totals are not going up by crazy amounts, I'm not super concerned about it. But I do typically just look at general trend, general direction, just to kind of give me an understanding of like liquidity. Is this company retaining capital? Is it increasing its leverage? In other words, are we increasing our debt on the business's balance sheet? Or are we moving ourselves in a positive equity direction over time? This practice is pretty stable. There's not a whole lot of variance between the first month over this 4-month period, the last month, total asset values, et cetera. as well as their total liabilities, as the liabilities are in a downward direction. So everything seems to be going well there. There is some credit card debt that's on the books, but that's nothing that's too concerning. It's not like the credit card liabilities are outpacing the cash balances or anything like that. And it doesn't look like our debt's getting too crazy or anything like that either. Distributions seem to be fine. In case there's any other accounting nerds that are watching this video or listening to the podcast, but I guess I should be explaining a little bit more what I'm seeing for the people that are listening on the audio only podcast episodes. If you're only listening on the audio, go check out our YouTube channel. You'll have the video where I'm actually sharing my screen and actually see what I'm actually referencing on this as well. What I'm looking at is, again, fairly stable practice. Don't see a whole lot of crazy stuff happening. Wouldn't be anything that would be too concerning of me on here. And again, the balance sheet analysis in terms of analyzing a business's health, it's funny because the one that can probably tell you the quickest if things are going really well or if things are going really wrong. It's one of the quickest ones to be able to see that. But most practices, it's the in-between stories that are the ones that are more interesting anyways. So this practice, everything seems fine. I'm not seeing big uptrends, big downtrends. Seems like it's a pretty stable practice. So I'm not really super concerned about that. So balance sheet analysis, that's how I view it. And maybe next month we'll have one that has a bit more volatility to this, and maybe I can talk a bit more about what that practice looks like comparatively. If I wasn't using an Excel version of looking at reports and I was actually going to go in and do a multi-trend, I might pull out a little bit farther back in terms of what I was analyzing, maybe do it on a month to month for an annual basis rather than doing just a 4-month, month over month view. But that's how I'd analyze the balance sheet. To recap that real quick, review asset balances, review especially capital and cash. Look for anything crazy that may be on there that's special, that makes me be more familiarized with that client quickly. And then look at liabilities, mostly debt, somewhat credit card liabilities. If the credit card liabilities are getting crazy, that'd be something I'd be worried about. And then equity as a remainder. Okay, so now we're done with the balance sheet. Let's move over to the income statement, which a lot of people are going to think is way more fun. So the way the income statement works is where the balance sheet is a snapshot in time, the income statement is telling a story. It is the activity over a period of time. It's not snapshots, it's activity. So on the income statement or the profit and loss, whatever you want to call it, it's a review of what's happening with the practice. So I'm looking at a 4-month profit and loss here, and I'm looking at February of 2025, January 2025, December 2024, November of 2024. I just pulled this literally out at random. I had a team member send me a copy of it and hide everything, so I can't even tell you which client this is. But in terms of looking at this, the first thing I see is like, hey, this is a steady as she goes practice. Revenue is pretty consistent. So it's 92,000 in November. It is 99,000 in February, 87,000 in January, a little bit of a dip. December was 91,000. I'm seeing a spread of $14,000 over the course of a 4-month period with the high and low ratios. And that's not super volatile. It's not uncommon. Some practices will see $70,000 in one month and 120 in the next. So this practice, I'm seeing, same story in the balance sheet, pretty consistent month over month time frame. Obviously, I look at income statements top to bottom as the way I typically review them. So income always comes first, revenue comes first, collections, those are dollars deposited into the business account. I do not typically go in and separate out patient fees into like different sources of income, because for dental practices, it's always patient fees. I don't typically go in and go, hey, this is a check purchase, this is a credit card purchase, this is a cash purchase, this is a care credit or whatever may be, insurance, EFT, whatever may be. I don't typically look at that because I'm worried about the financial analysis from an accounting standpoint, not a practice management standpoint. Practice management analysis is outside the scope of what a CPA typically will do for you. And so getting too far into the weeds, it only ends up hurting the analysis. So income first, look at that revenue, look at volatility, look at levels. This practice seems to be in a pretty good spot in terms of revenue from being consistent. Now, does that mean it's doing a great job? I don't know. When we get further into the analysis, I can give you a bit more understanding of that. So the second part of the income statement of profit and loss is the cost of goods sold area. Cost of goods sold is a very common term in accounting principles. Cost of goods sold is effectively the cost associated with generating revenue. So it's the cost that's most directly correlated to the revenue coming in. The way that our firm defines this is we say that your clinical assistants, your hygienist, your dental supplies, your lab fees, and your associates are your cost of goods sold. It's really cost of services with dental practices because there's no actual goods that are being sold other than services. So cost of services is a better term of that. Our accounting software just automatically calls it cost of goods sold. But if I could relabel that to cost of services, I would say that'd be a fine thing to do. And the reason that you do that is because you want to create an analysis between how much does it cost us to create this treatment and to service and fulfill treatment as a specific number ratio. That is a number that you want to be aware of so you can get an understanding of like how much you're spending on it. So the two areas that cost of services is one, it's the direct cost, or what commonly called direct cost. Typically, cost of goods sold is a number that's way more important in something like a manufacturing company, because it's like, hey, I've sold widget A for $1 and it cost me 37 cents, 37% of revenue to generate cost of goods sold. So that's a 37. That number is a number that cost accounts will geek out over and try to optimize over time. Dental practices, when there's people involved in medical services and you're less than like a $10 million a year practice, it's not as relevant as, say, like a manufacturing company that typically has to hit some certain economy of scale for those costs of goods sold to be at a lower price point or something like that. I do typically look at when I'm trying to give like a full analysis of a client or a practice. And so for this client, cost of goods sold, obviously December number went up quite a bit compared to the other months. So the numbers I'm looking at, I'll say all four of them, November, December, January, February, 29,000, 37,500, 24,000, 30,000. My guess is that December is higher because of the fact that it's December and either one of two things happened. Either December was a 3 payroll period month for this person. So little thing that everyone needs to understand when it comes to payroll, most dental practices pay out either every week or every other week for their team members. Every other week is definitely the more common than every week. I actually recommend do it every other week. Do not recommend doing it every week. That gets to be a big headache. So I would say do it every other week. If you can get it to be twice a month, that's great. But the way that works with a lot of the feedback we get from our clients, from their team members, is that the consistency of every 2 weeks is more appreciated than twice a month. Very common that it's every 2 weeks. Again, if you're in every 2 weeks practice, then 2 times a year, there will be 3 payroll periods in a month. That's just how the math works. There's 52 weeks in a year. Every other week means there's 26. That means if you divide 26 by 12, there's 2 payroll periods in 12 months. It's 24 of those 26. That means there's 2 more floating weeks that are out there. So 2 months out of the year, those weeks fall into a month. My guess is December likely was that for this client. My guess is that they also did bonuses for Christmas as well, which is the reason cost of goods sold went up. Is that something that I need to like put into some type of really complex analysis format? No, it's not. It's just something that we got to recognize and be paying attention to is that, hey, December is typically a higher payroll period month, or those 3 payroll period months, they do typically tend to be higher. Maybe something that you'd be looking at in terms of analyzing and just paying attention to. A lot of people kind of think that financial analysis is going to give you this mathematical formula that's going to solve how to be a profitable dental practice. And it doesn't really work that way. It's really more about just analyzing what's happening and being aware of it, and becoming familiar with it so that whenever you do run into those things, you know how it's going to impact your business from a cash flow perspective, as well as from a performance perspective, so that you can be very, very comfortable with how your business is performing and be able to see things before they happen so you can plan out accordingly. In terms of cost of goods sold for this client, if you remove the December one, which is typically a bigger payroll period month, for most of our offices, most people do give Christmas bonuses or holiday bonuses, whatever you want to call it, year-end bonuses even, then that's reasonable. But it is something that if I was talking to this client about, I was like saying, hey, were you expecting this? Is this something that you're paying attention to? Yes. Okay, cool. Then we're all good there. If no, and then I'd say, oh, well, was your hygiene wages double in December for that reason? And they're like, no, it should have been the same. That'd be something that client would need to go look at to make sure that it was done in the right way. So outside of that, yeah, I do typically look at that, just look at the trend, get an understanding of it. It is something that if you want to track, you can. I don't think that it's like the most relevant thing given the size of most dental practices. The way that you do that, you take the total cost of services divided by your total income, and that'd give you a percentage. And what I do is I do that for each period that is in there, and that would give you your cost of services percentage as a litmus test for you to understand. So for this client, you can see, so I just did that on screen for people that are listening in. They had cost of goods sold, cost of services percentages of 30%, 28%, 41%, and 31%. The average over those 4 is 32%. So this client averages about 32 cents out of every dollar. The way that you conceptualize this is every dollar that comes into that practice from a revenue generation standpoint, it costs us 32 cents to service that revenue, that collections. So we're spending 32 cents to make $1, right? It's great. That's a fair trade for a lot of people. Most people would happily trade 32 cents for $1. But that's how you measure effectiveness of the financial performance is by that. Now, that's the direct cost. That's our people. Again, that's our hygienists. That's our assistants. That is our associates. That is our dental supplies. That is our lab fees. Thanks for listening to the Tooth and Coin podcast. If you enjoyed the show, we'd really appreciate it if you could leave us a 5-star review as well as a written review. Your feedback not only helps us improve, but also helps other dental professionals find our podcast and benefit from the financial insights that we share. So thanks for your support, and we'll catch you in the next episode where we'll continue to explore the business side of dentistry.